Fixed income markets are an essential aspect of the global financial industry, ideally providing investors with a dependable source of income and stability. I slipped in the word ideally because we are exiting one of the worst years in recent history to be invested in the fixed income market. This presentation will explore the current state of the markets, provide an analysis of the latest trends and developments, and make predictions and recommendations for the remainder of 2023. The presentation will last approximately 30 minutes. Our goal is to provide information to investors to help make informed fixed income decisions by answering three key questions. 1, why did central banks raise interest rates so quickly? 2, how do investors generate a dependable source of income and stability in 2023? And 3, which fixed income product trends should investors consider or ignore? My name is Curt Cumming. I am the president and one of the founding partners of Goodwood, which we began in 1996 when we became one of the first alternative investment managers in Canada and was a founding member of the Global Alternative Investment Management Association based out of the United Kingdom. I am fortunate to have had the experience of managing and allocating capital to various asset classes. Before joining Goodwood, I was an institutional trader at a $6.5 billion mutual fund company, and prior to that, an investment advisor for high net worth families and family offices. Goodwood now manages prospectus and non-prospectus mutual funds, limited partnerships, segregated accounts for institutional investors, and direct private clients. I will start the webinar with our conclusion: buy investment-grade corporate bonds. The main reason why investors should choose to include corporate bonds in their portfolios is due to the unique features and benefits these bonds offer. These corporate issues provide reliable income and capital growth. Unlike stocks, which depend on the success of the underlying company, corporate bonds provide guaranteed fixed income from regular coupon payments and provide and offer capital gains from rating upgrades and credit-enhancing events. The term structure of an investment-grade corporate bond makes them a liquid, dependable source of interest and capital income, particularly for those looking to supplement portfolio income and reduce overall return volatility. At the beginning of the pandemic, a sense of uncertainty permeated the capital markets. The world watched as the coronavirus began to spread across continents, infecting people at an alarming rate. The virus outbreak left governments scrambling to contain it, and people were forced to adjust to a new reality of social distancing, virtual communication, and economic uncertainty. An increase in fixed income activity marked 2020 and 2021 as investors sought a safe haven amidst the uncertainty created by the pandemic. Worldwide, central banks also maintained its accommodative monetary policy, keeping interest rates at almost 0%. In 2022, central banks started to raise interest rates to combat inflation. As we all know, making borrowing more expensive should reduce aggregate demand and consumption levels. We are all watching inflation carefully as it has significant implications for the financial markets. Secondly, central banks implemented unconventional economic policies during the pandemic, such as quantitative easing. By raising interest rates, central banks aim to return to monetary policy, stabilizing the economy and preventing further imbalances in asset prices. Finally, central banks raised interest rates to manage financial vulnerabilities. As we saw with the Silicon Valley Bank and the other U.S. regional bank debacles, low interest rates led to higher levels of debt, posing an increased threat to financial stability. By raising interest rates, central banks aim to encourage responsible borrowing and discourage risk-taking, thereby safeguarding the overall health of the financial system. While the central banks knew these policies would have adverse economic effects, it was necessary for maintaining long-term financial stability and promoting sustainable growth. But as interest rates rise, bond prices fall. Most investors expect bonds to rise when stocks fall. However, this was not the case in 2022. By year end, the TSX fell by almost 6%, and the iShares bond ETF declined almost 12%. What should we expect in 2023? The Bank of Canada has raised its interest overnight rate from 0.25% to 4.5%. We believe the Bank of Canada is now signaling a pause in monetary policy, and the U.S. Federal Reserve is expected to implement a final 25 basis point interest rate hike at its May meeting. Please note the 2023 Q1 return for our fixed income benchmark. The bond market has started to price in a pause in interest rates. As such, in early January, we recommended that portfolios selectively extend duration. As the old adage states, as interest rates rise, bond prices fall. But the reverse is true too. As interest rates fall, bond prices rise. We are now at a point in the interest rate cycle where our advice is simply to buy more bonds. Our primary objectives of this webinar are to review the economic factors that impacted 2022 fixed income returns, provide our 2023 forecasts in order for investors to generate independent return expectations, summarize our tactical and active fixed income approach, and highlight recent fixed income trends in the marketplace. I want to introduce Chris Currie, Portfolio Manager of Goodwood Milford Fund and Goodwood's segregated institutional and private client accounts. Chris has invested in the fixed income market for over 25 years. Although Chris has worked for Goodwood for over 10 years, his investment background includes portfolio management positions at OMERS, TAL Asset Management, and as a corporate bond credit analyst at CIBC World Markets.
Great, Curt. Thanks very much. And I'd like to thank everyone who's taken the time out to listen to our webinar here. Our approach to fixed income is we like to emphasize corporate bonds. And the reason is that there's 3 extra ways you can make money beyond just changes in the market levels of interest rates. So we're not interest rate anticipators, which is really the strategy of the group that invests in treasury bonds. We're corporate bond specialists, and why we like corporate bonds, number one, high coupons. Right now we're seeing 5 to 6% in coupons in the new issue market. We also like the potential for spread tightening as corporate fortunes improve, much like stocks. Stock prices go up, PEs widen. In the bond world, that's called spread tightening. The third way you can make money is for credit rating upgrades, which introduces the particular security to a wider audience, because as the credit quality goes up, a wider group of potential buyers exist, be it moving from insurance companies into pension funds into more restrictive accounts. That just broadens the buying base. So we're Canada focused. We do have some foreign issuer bonds that have issued in the Canadian market, and we have some Canadian companies issued in the US market, but we're primarily Canadian dollar. So on the next chart, I want to show that just a quick snapshot of what's happened to interest rates. This is the 2 interest rate curves from the end of 21 to now, and you can see these are yields at all points across the maturity spectrum, from very short to the long 30-year plus bonds. You can see the tremendous movement in bond prices, or bond yields, sorry, in the very short end. Almost 4x. Like back at the end of 2021, we were looking at 2-year rates, below 1%. Now those rates are in the 4% range. So just a tremendous movement as Curt's gone over the factors. Probably, good time to introduce now our thesis. Maybe we can turn to the next page, which is that, we think that there will be some form of recession, but excuse me, we think that, the fears of a recession are being overdone. So that's caused spreads to back up unnecessarily. So we think that there's a buying opportunity there. So we think any recession that does come to pass will be shallow. and brief. Reasons for calling for a recession, are well known. The yield curve's been inverted for a number of quarters here. The index of leading indicators, number of months that's been negative. Same with the ISM manufacturing PMIs. On the next chart, we show this is the basis for a deeper recession, which is that, the leading indicator chart, which is, I want to show it, or try the yield curve predicting recessions, which is on the next page. And you can see here that the gray bars are recessions. This comes from the Federal Reserve of St. Louis. And you can see this is 2s minus 10 or 10s minus 2s. And every time that goes below 0 into negative territory, it's followed by a gray bar. But, I don't want to be one of those guys that says this time is different, but, this inversion is one of the worst kept secrets in the bond market. And we've been living with this inversion now for, getting on close to a year. So, we have to wonder about the effectiveness of that predictor, given that it's been out there for so long. Our view on the next page is that we're really going to see a shallow recession. And the reason for that is that the economy is still growing. Employment is still strong. And, the simple equation that consumer spending is 2/3 of the economy. Consumer spending is driven by the level of employment. Employment is still very strong. If people have jobs, they have a propensity to spend. That's going to stimulate the economy. I just noticed that Ford released results this morning and their sales were up, in the high teens level. So people are spending, they're buying cars. It is very hard to call a recession if you've got that level of consumer spending in the economy. And there's what I think the recession, people that are calling for a deep recession are not focusing on, which is illustrated quite well in the next page, which is, the importance of unemployment to, a recession call. So at the St. Louis Fed, one of their senior economists, Dr. Claudia Somm, she observed that, the front end of a recession can be, very clearly predicted when the 3-month average unemployment rate exceeds the 12-month average unemployment rate by 50 basis points. And, if you wanted to go to the website, you can really zero in on that point and you can see it in great detail, but this is a broad brush here. And you can see that we're nowhere near in the positive basis points of the 3-month range. So, the most conservative statement I can make is, we're at least 3 months from any recession call because, employment is just not indicating that we're in the front end of a recession. So on the next page, wanted to show you what the market's thinking. And the orange line here is the move up in US Fed funds rate. And they're widely expected today to raise another 25 basis points. And the market, the 2-year rate, 2-year yield is in the blue line. And you can see the big divergence there where the 2-year yield has fallen dramatically. And I think the two lines indicate we have to examine the basis for, why these lines are as they are. The Fed, is analyzing backward looking data, takes time to report numbers and they only base their judgments on numbers that have been reported, whereas the market, is anticipating future events, rightly or wrongly. So the market, when we entered in early March, the Silicon Valley bank crisis, was anticipating perhaps a greater financial turmoil than what's come to pass. And they were, a lot of forecasts were out there for Fed cutting in the summer, in the fall. Recently, the 2-year bond has risen in yield. And that's, as a result of people taking those forecasts, clawing back those forecasts and saying, okay, well, the regional bank situation seems to be stabilizing. Jamie Dimon has made the statement that the regional bank crisis is over. So I think that's resulted in Fed cuts being pushed out further into perhaps the fall or 2024. So next page, wanted to just present you with a sample of bonds that are in all the Goodwood funds. So you can see that our focus is really on short-term bonds. We really think the best strategy is to capture those high coupons, 5 to 6% in the sub 2-year area, because we think we're going to be there for a while. We think the Fed, at this meeting or the next meeting is going to announce that they're going into a pause mode, and we're not going to see cuts for a while. So, going out the yield curve, 10 years, 30 years, which is, you're really trying to get capital gains out there from a falling level of yields. We don't see that happening because the employment situation is so strong, it's not going to generate recession calls. So let's capture the current coupons that are out there, 5, 6%, and let's rely on high levels of income to provide our return. So the next page is really the stock and trade of corporate bond analysis, which is really spread analysis. So what spreads are in their essential terms is the level of yield over the equivalent term risk-free rate from the government of Canada. So 2 bonds here we analyze, both very liquid bonds. They're, BCE bond in orange, both over $1 billion in liquidity. BCE bond in orange, you can see it's lower rated than TD Bank, which is in blue. So it carries a higher spread. Did want to reference the TD Bank because it's an interesting case study, so to speak, in spread trading. You can see that spread really widened out in March, and that's a direct result of the regional bank crisis. TD has a big existing business in the US, and they're also under contract. They have an offer in hand to buy a US regional, and so people are concerned over whether that acquisition would go ahead, whether it would be renegotiated. So that caused the spreads to back up, which presents a buying opportunity for our eyes. And then you can see in the latter part of March into April, those spreads tightened back in as investors became more comfortable with the regional bank situation and the TD's position. So the next chart is really a sample of issues that are out that we looked at that represent sort of segments that we thought were interesting in the corporate bond market. Bonds in bold are bonds that we happen to own. So we're looking at the what we call the sweet spot, which is short-term, high coupon bonds. You can see them listed there. The next segment would be, if we wanted to increase the risk a bit, we could increase the maturity, increase the duration range, and you can see we're still getting attractive coupons. These are all investment grade bonds, and I wanted to make the point here that Goodwood is in a unique position as an institutional dealer. We see all the new issues from every dealer. Being an advisor or an investor, sometimes it's hard to get new bond issues. A number of reasons for that. One, a lot of them are never shown to retail. Number two, if you happen to work for a particular dealer, maybe you'll get access to that dealer's issues, but you won't see other dealers' issues. And then number three, the bond market is an over-the-counter market, really institutionally traded. So these new issues happen with a very rapid time frame. I mean, they're typically announced in the morning, comes out with a statement, books close in 10 minutes. So, you have to be at your desk all the time, ready to, to receive those emails, receive those phone calls, and an issue's coming. And, they can be quite lucrative when we're in an active new issues market. But let's look at the last segment there. We call this only for the brave. And this is a combination of very high coupon, high yield bonds. You can see the Obsidian Energy close to 12%. Shawcor we own, which is a 9% bond. We own that in our mutual fund trust. It's a very strong company. We like that coupon, 9%. Quickly talk about the last one, which is kind of fun, which is you can't, we can't criticize the credit quality of province of Ontario. They have the ability to tax, so that gives them a very high credit rating. But look at the price on that, $64. So that's a result of the very long term, almost 30 years, and the very low coupon. So to generate a current market yield, which would be in the sort of mid to low threes on a provincial bond, you have to discount the price. So that gets you the $64. But interesting aspect of that is, what happens if rates drop dramatically? That bond could easily gain $10 in price. What if that happened in a quarter? Annualize that, which, you never do, but that's a very healthy return. That bond could easily go into the low 70s. So, wanted to point out that we have different strategies in our toolkit, and, we're constantly looking at opportunities for our investors on our investors' behalf. And the next chart is, I believe I'm handing it back to Curt.
Thanks, Chris. So as we approach the end of this interest rate cycle, investors must analyze new fixed income trends and decide which strategies to implement and which strategies to ignore. One trend that's become increasingly prominent is the rise of green bonds. These are fixed income instruments that companies and governments issue to fund environmentally friendly projects. With climate change becoming an ever-present issue worldwide, many investors are seeking ways to gain exposure to these issues. When the yields are attractive, Chris integrates these green bonds into our portfolios as they offer financial return and social benefit. We expect this fixed income trend to continue to provide opportunities. Another trend is the integration of ESG factors into fixed income investment strategies. Environmental, social, and governance factors are now at the forefront of institutional investors as they consider their portfolios' long-term sustainability. ESG integration has become an essential part of an investor's due diligence, as it can provide a more holistic view of the company's risk. As we discussed earlier, corporate spreads refer to the difference in yield between corporate bonds and government bonds of similar tenors. We think North American supply volumes are likely to be in line with the 2022 total of 1.25 trillion, and we believe corporate spreads may be too wide as investors fear a severe and deep recession. We think the odds of a deep recession are less than 30%, providing an opportunity to incorporate spreads. Artificially low interest rates during the pandemic sparked a trend for fixed income product manufacturers to incorporate excessive leverage into their portfolios to increase distribution yields. With higher interest rates, we recommend investors monitor external product leverage for hidden risks. We expect product leverage ratios to revert to pre-pandemic ratios. We've all read about the rise and fall of private credit in Canada. One of the main dangers of private credit is the lack of regulation and oversight. Unlike traditional financial institutions, private creditors are not subject to the same rules and regulations, making them more vulnerable to fraud and illiquidity issues. We believe private credit funding opportunities will remain a predominantly institutional offering for the next few years. Shorting the yield curve is another trend that has emerged over the past decade, especially among hedge funds and institutional investors. This strategy involves betting on a flattening or inverted yield curve. It is a complex strategy that requires careful analysis of market conditions and interest rate movements. In the Milford Fund, we expect this strategy to remain a hedging mechanism rather than a capital gain opportunity heading into the back half of 2023. Active duration management was uncommon for the past decade, with most large manufacturers marketing low duration funds. Active duration management is extending or reducing duration exposure to reduce risk or increase return. This can be achieved by shorting the yield curve or by investing at various maturities along the curve. For example, with the current inverted yield curve, Chris is investing in short-term issues with high interest rates, but we're also watching longer-term 10-year government issues to extend duration and capture potential capital gains. Ideally, you want to allocate capital to portfolio portfolio managers that have the ability to manage duration through a barbelled or laddered approach. And we believe this trend of duration management will gain momentum in other fixed income offerings. Large, well-known mutual fund mandates have traditionally been the go-to choice for many fixed income investors. Unfortunately, because of significant institutional assets under management, these funds cannot be actively managed or have narrow mandates or do not have the access to quality opportunities that will impact their returns in a meaningful way. These mutual funds come at a high cost and are less flexible. ETFs have become an increasingly popular choice as they offer a low-cost, diversified investment option that is liquid and tradable like a stock. But therein lies the problem. ETFs are stocks that are supposed to replicate fixed income return profiles. However, ETF investors are not repaid principal and coupon. There's no term structure for an ETF. That said, we expect fixed income ETFs to gain, or continue to gain rather, significant retail capital in 2023. The Goodwood Milford Fund's 17-year return history has a core strategy of investing in fixed income securities selected to provide higher coupon income and capital gains from credit upgrades. The long-short credit-focused strategy has a flexible mandate, allowing the fund to generate returns in a rising or falling interest rate environment. Investors can allocate capital to a total return class or to a distribution class that issues a 4% cash yield. The strategy has been a consistent top quartile performer, winning numerous industry awards for best return, but also Sharpe ratio. You may recall if you took the CFA that a Sharpe ratio measures the risk-adjusted return. The Sharpe ratio reveals the average return minus the risk-free rate divided by the standard deviation of returns for that investment. The Goodwood long-only institutional and private client investment-grade bond mandate's objective is to preserve capital and provide a high rate of cash coupon. The portfolio invests in very liquid issues, and for security, the portfolio may invest in Canada's or provincials to manage duration exposure rather than creating a perpetual short duration fund. The mandate invests in approximately 25 fixed income securities targeting 200 to 300 basis points over the 5-year Canadas. The Goodwood institutional and private client ESG conscious investment grade bond mandate is typically invested in a portfolio of very liquid issues generating a yield to maturity of greater than 4%. Issue selection is made from a universe of issuers that have achieved good scores in a third-party ESG evaluation process and offer products or services that are socially acceptable and support sustainable development in ethical businesses. Our primary objectives of the webinar were to review the economic factors that impacted the 2022 fixed income returns and provide our 2023 and 24 forecasts. I started this webinar by stating our conclusion, which was, we recommend increasing your allocation to bonds, or more specifically, to increase your allocation to investment grade bonds to provide a liquid, dependable source of interest and capital income and reduce your overall return volatility. We will be hosting this webinar series every quarter. Please send me an email at the email address you see on the screen if you have any questions, or if you'd like to receive future editions of this webinar. And thank you very much for taking the time to listen.